Well, our portfolios got a brutal flogging on Friday on both the equity and the crypto front due to a re-escalation in tariffs. Quick aside, the fallout and depegging that we saw on the crypto front, that is its own story that's very complex, and it would take more time to dissect than we have today. But if you want a full breakdown on how the rails collapsed, check out Elon Trades on X. But today we got a great initial recovery on both the S&P 500 and the Nasdaq, which both reclaimed over 50% of Friday's losses. Crypto, for its part, it held up strong over the weekend and gave us a positive weekly candle close for most of the major players. So, is the worst behind us, and can we consider this all one big misunderstanding and a simple reset to get the bull market back on track? Well, the historical stats would point to the potential for a few more bumps ahead despite a longer-term bullish outlook. But ultimately, as I always say, we need to let the price action lead. So let's dive right in to review the key charts for stocks, commodities, and crypto. Let's go. This isn't financial advice. Past results are not indicative of future performance. Do your own research. Welcome back to the Trading Apologist. My name is Tom, and I hope you all had a wonderful weekend. Before we dive in, likes, comments, and subscribes are very much appreciated. They really help the channel out in these early days to get more traction. It means a lot to me personally, and because I clipped Trump on Friday, now I have a political restriction on my YouTube account because midterms are coming up. Awesome. So I know the turbulence in markets is the main story, but since we didn't get into it on Friday, we have to briefly touch on earnings season. First, we have major banks starting to report tomorrow, with JP Morgan, Citi, Goldman Sachs, and BlackRock leading the charge. The tone they set will ripple through the broader market, and if they sound upbeat on tokenization, leverage, and borrowing, that could reinforce the risk-on narrative. But if we start hearing more about delinquencies, bad debt, or tightening credit conditions, that could cast a very different tone. Then, as another leader in current markets, we have semiconductor earnings starting to roll in this week. ASML gets things started on Wednesday, and TSMC follows on Thursday, and that's the one to really watch since NVIDIA reports so late in the quarter. TSMC's guidance will likely set the tone for the semiconductor sentiment over the next several weeks, and we need that sector to keep moving to see a persisting rally in markets. Now, we're going to talk more about the bearish engulfing candle on the S&P 500 and Nasdaq and the subsequent recovery as we get into the charts. But I want to lead with a review of a few historical comparisons and stats to give us a sense of where we sit in the cycle. The TLDR is that if you're in longer-term positions, there's really nothing to worry about. Even with this little correction we're seeing now, there is a general bullish outlook. However, if you are in swing trades or leverage positions, you may want to be a little bit nimble over the next few weeks, as October can be choppy, but the general trajectory for Q4 is positive. First, our current rally has been almost perfectly mirroring the first leg up we see after a major recessionary bear market low, and we did have a technical bear market in April with a greater than 20% pullback. The pace, slope, and breadth are all comparable to the sample years in question, and if we do compare our current positioning to the historical averages, we seem to be entering some chop or a correction phase, which may be what we're in the midst of right now. And note that Friday's drop is not yet represented on this chart by the green line. Looking next at this chart, which illustrates the S&P 500 average performance when September finishes positive and every trading day from June through September holds above the 100-day moving average, which we had this year. The market often continues higher, but later October underperforms compared to the rest of Q4. Now, historically, October 20th through 27th are the worst times in the market generally of any Q4, and this is where we normally set our low for the quarter. This time, however, it looks like we might be pushing that correction forward, coming a bit earlier than those historical norms. If we pivot over to this chart, you can see a numerical representation of returns, and that more challenging October is clearly contrast with the much more positive returns for the remainder of Q4. And that is a nice 100% read as well, which we don't always get. Shifting to the Nasdaq, we just reset a key metric, the days since the last negative 2% move. What we saw recently has been highly abnormal, which is why I said in Friday's video that the correction we saw on Friday is what we should consider normal. We went an unusually long stretch without meaningful downside volatility. That reset now brings us back to a more balanced volatility profile, which often sets the stage for a more substantial move. That said, Friday did provide an extreme read in the Nasdaq when the Nasdaq hits an intraday all-time high, but then closes 3% or more lower. That is a late cycle signal. Historically, it often foreshadows a bigger correction, but most often flashes during the building of a multi-year blow-off move. And it doesn't signal the top in itself. 2025 performance has had a very similar overlay to 1998. So if you're looking at this chart, you can imagine roughly where we are in the midst of that move leading into the 2000 dot-com bubble. So if I had to summarize all that, the macro trends remain intact and all signals still point to a positive post-rate cutting cycle trajectory, much like the one we have been discussing for weeks now. And I am actively out there looking for signals to the contrary that would tell us that we need to be a bit cautious, and I'll of course report on those if and when any meaningful signals come through, but I have just not found them yet. For the current price action, if we see a fast bounce over the next couple of days, that would obviously point to a quicker bullish recovery like we saw over the summer after the last bearish engulfing candle. But if the historical averages hold true, that would point towards a couple weeks of chop before more continuation. So don't be surprised if October volatility persists. Now, with all that outlined, let's dive right into the charts. Okay, starting here on the S&P 500, and instead of the normal SPX chart, today I am on the ES1 exclamation point chart for the S&P 500 E-mini futures, so we can see the overnight price action and continue to track our recovery. If we go to the weekly, these pink boxes, I've just drawn those to correspond to other weeks where we got a bearish engulfing candle so we can see how long the recovery takes. Obviously, that recovery we mentioned over the summer was really quick and happened the next week. But on average, you can see 3 weeks, 3 weeks, 3 weeks, 2 weeks, 3 weeks, 2 weeks, 2 weeks is kind of the norm, 2 to 3 weeks for a bearish engulfing candle on the weekly. But this has been the third fastest recovery in history for the S&P 500. So we shouldn't be surprised if that momentum continues. And that's why I said we just need to go with the money flow on the charts and let price action lead. But if we go back to the daily, just to measure out the 50% of that recovery and to look to downside targets, if this correction continues for another week or two, we should look to the 20 weekly as a point for support. That's where the street normally steps in. I'll go back out to the weekly in a second just so we can illustrate that point. But if we look at our recovery here from the high last week to the low, you can see how we are sitting nicely above the 50% level right there. And that is great to see on the first day of the recovery that we already got above the 50% of the range. And just really quickly going out to the weekly, you can see how when we have these larger corrections, traditionally support comes in right at that 20 weekly. This was a little bit more meaningful correction here back in August of 24. That was the yen carry trade low. So when that final flush happened, we dipped below, I think it was just for a day, but for all intents and purposes, we found support at the 20 weekly, 20 weekly, 20 weekly right here, time and time again, 20 weekly, 20 weekly. This one dipped below too, but this kicked off our 2022 bear market. So that was a little different story there, right? Okay, let's move on. Moving on to the Nasdaq, similar story. I don't have the futures chart up here, but the daily is good enough just to illustrate that we got above the 50%. And the Nasdaq actually had a slightly stronger bounce and is up in overnight too. I think it's up like 60 points right now. And you know what, while we're here, why don't we pull up the Nasdaq futures as well, just to really do it right. Oh, we've pulled back a little bit on the overnight futures, but you can see we are still generally positive and trending up on the Nasdaq. So I would expect that to carry through to tomorrow morning, and we'll have to see how things react once banks start reporting earnings. Okay, moving over to the DXY, which does look like it's starting to form a bit of a base and is trying to recover. You can see that the confluence model clouds are starting to move a bit horizontally, which indicates that consolidation, and maybe it can try to mount a bit of recovery. But right now we are finding a lot of resistance at this overhead trend line at 99.5. This red zone that I have drawn in here, this played a ton of support for us. Well, I guess not a ton, but it was the low of this consolidation range. So it is a meaningful zone just because of that. And you can see how we've had a lot of congestion around that area. So interesting to see what the dollar is going to do, because from a macro sense, I still do believe the dollar is weakening, but that might take months and years to play out. If we look over to gold, gold cannot be stopped. No, it just hit our, I think on Friday, or it was last Monday, we talked about the fib extension from this last consolidation range being between 41 to 4,200, and we are smack dab in the middle of that right now. So let's see if gold finally gets to another point of consolidation. This has been an unprecedented run. And if we flip over to silver really quickly, I saw headlines today about silver going to $100. Silver's been on a tear. It overshot my target. I thought it was going to hit about $45, and we're already at 52. So fresh all-time highs for silver has really been outperforming. But when you start seeing those headlines of everybody saying it's going to $100 and the rally's not going to stop, and I've seen gold to 10,000, silver to, I think 100, that's usually a sign that you're closer to a local top than anything when that kind of euphoria steps in. But I'm happy to be proven wrong and see these things continue to rally as that flight to hard assets continues, and hopefully that trickles over to Bitcoin soon. I wanted to go to NVIDIA, but here's LAES, which had a great recovery today. We're still targeting 722, so if you're in that trade, good job. Should hit the price target, I imagine, in the next couple of days. But NVDA, as the leader of the semiconductor space, and the good thing about NVIDIA, if we look on the daily, is that we reclaimed our trend line breakout at that $185. We deviated underneath last week. The 4-hour candle actually rejected underneath that breakout zone. So getting back above today, firmly above that, is a good sign. So we want to see NVIDIA continue on in this recovery, or I guess this next leg higher, not a recovery, for the rest of the semiconductor space and markets more broadly to follow along. So that's the main reason I'm tracking NVIDIA. As goes NVIDIA, at least in recent market conditions, so goes the rest of the market. Okay, bringing in a new one, CLF, and we covered about 5 metal stocks in the weekly kickoff and market prep call for my Patreon group this morning, but this is a standout one that I want to cover here as well for everyone. And a lot of the metals plays are just breaking out of multi-year downtrends. And while most of the market is overheated and it's not in a scenario where I would look at playing leaps or building longer term positions, a lot of these plays are at that point in their cycle. So even though we're in a broader bull market for markets, certain sectors run counter to that cycle and give you opportunities to enter now, like we had on a lot of tech names back in 2022. Anyway, let's look at the chart, because when I analyze these, I like to start on the weekly and get a picture of what's going on. And we've clearly had that recovery and breakout on the weekly. But if we draw downtrending resistance from the all-time high up here back in 2022, and we draw that right down, we actually just got into it for a third touch point. So we often reject from a third touch point and then have a fourth time breakout. The question is that going to continue to be the case this time? And originally when I was looking at this, I was just trying to identify a zone for support. And you can see I have this dotted line drawn here, which actually here we can take off. I have it as an alert, but I had drawn a horizontal line across all these lows and daily candle closes here, just as an area to anticipate support. And I was thinking, okay, maybe we get a pullback to this zone. But I have to give a shout out to Fire in the Patreon community, who spotted something quite different, which I think makes a lot more sense. And it makes me really happy to see everybody in the community learning TA and spying these things for themselves. And he noted this inverse head and shoulders pattern, which is very clear on the charts. So if we draw that line across and we map out from the low, here we go, to that high right there, and project that to the breakout candle, now we have a price target to the upside. And we also have a line to watch for a potential bounce, which is why I now have this alert set here. If we get a little pullback here from this rejection and we get a bounce back testing this neckline break for support, that would be a fantastic entry if you are not in this name already. And that would also align on the daily with the Confluence model center cloud. So let's see if we can get this kind of scenario to get the breakout, you can see we have volume increasing as we're getting into this resistance, which is a good sign for pushing through, and we want to see that volume continue. And if we look just at the target from the inverse head and shoulders, that takes us to $18.85. We are currently at $13.83. If we get lucky and get an entry around $12.50, that could be even better. And just for that near-term move, if we're measuring from the low, that would be about 50%. And if we just continue up from here and get the breakout, that would give us about 36%. So not bad, but this seems just like a near-term price target to me. And this could be something that goes on, a multi-month, maybe not multi-year, but at least multi-month recovery. So if we can move up to the target, I imagine we might still chop before heading higher, but an interesting play to keep your eye on. Okay, if we are looking to Bitcoin on the weekly, and I am pulling up a different chart than I normally do. I'm pulling up the crypto.com, I believe, chart right here, which has a wick down to about 103,000. Some charts like Coinbase are showing we only got to 107 or so, right above the 200-day moving average. Others went down to like 99, I want to say. But whenever you have a big depegging event like this, where different exchanges are showing different prices, the best way to apply TA is to take an average of those lows. And I haven't actually taken a numerical average of all, say, the top 5 or 6 exchanges, but this one was sitting in the middle of the road because some wicks were only going down to 111K. So middle of the road, I was using this as a guide for the weekly candle close, and I wanted to see us close above the 50% level, which we just got at 115.1 for that weekly candle close. So now this candle is looking much more bullish. We don't have an engulfing candle on the weekly. Obviously, this was a big event that broke a lot of market structure, but we couldn't have asked for a better weekly candle close. Now we are pulling back a little bit right now overnight, but as we get into the smaller time frames, you'll see as long as we bounce from 112,000, we should be all right. And the thing we need to watch this next week, so we had our downtrending weekly RSI that we broke out from, and we just bounced from that, and now the candle is perfectly tracking with this downslope. So we need to see more positive price action in the week ahead to really continue this recovery. So we're not out of the woods yet, but it's a good start with that weekly candle close. If we look to the daily time frame, where we can get a bit more detail of what transpired over the weekend, you can see how we closed above that 50% level on Sunday. Here's our Monday and Tuesday candle. So a bit of a doji candle on Monday, but still fine for all intents and purposes. And right now, as long as we bounce off the Confluence model center cloud lower band, I'm still feeling fine about this. And we also have the 382 level, which is sitting right at 111.9. So that's why I was saying 112,000, just for sake of round numbers there for Bitcoin. Okay, starting on Solana, which held the support we needed it to, which was that 200-day moving average, the Confluence model center cloud here, and most importantly, this underside trend line that has marked our broader uptrend since the April 7th bottom. So holding that and the bounce is a good sign. If we go into the 4-hour, we're seeing that we're just finding a little bit of overhead resistance at this downtrending trend line. When our sell-off accelerated, that's our minor overhead resistance. We have the major overhead resistance right here connecting these 2 points. So it's fine that we're seeing a sell-off. I would want to just see a bounce at this zone right here, which is the top of this past consolidation range, our Confluence model center cloud on the 4-hour, which is right around that psychological $200 price point, just underneath. So a bounce from there, and Solana is still strong. Even if we bounce from before there, that would be even stronger. And then hopefully we can see a break of this trend line. Maybe we backtest it for support and continue the recovery from there. That would be the ideal path forward. Of course, we need to see how things actually shake out. But all in all, the bounce right now is looking encouraging for Solana. Okay, really quickly looking to Ethereum, which had a stronger bounce than Solana percentage-wise, and got back within the Confluence Model center bands on the 4-hour a little bit sooner. But then today on Monday, the strength for Solana definitely outpaced Ethereum today. And I wonder if that's just because of the forthcoming ETFs and rumors of those launching later this week. We can probably get rid of this trend line here now. Although, let's just keep it on just in case we get a little bit of resistance as we get back into that. So I was saying that Ethereum yesterday, that Ethereum looks like it's poised for another big move. Little bit of weakness today, and I wouldn't even consider it weakness. It's just money rotating and chasing Solana, I think, for the hopeful news of those ETFs coming. But if we can hold this support zone right here at about 4,100, 4,100 has really become a more important level for Ethereum than 4,000. But seeing a continued recovery from here, I imagine we would sooner than later be testing all-time highs eventually. So still keep your eyes on Ethereum. I know the technicals are better on Solana just in terms of adoption, speed, number of daily active users, all of that. But there's still a lot of institutional hype behind Ethereum. Okay, MicroStrategy is still looking weak in the charts. We are just underneath the 382 level here on the fib retracement, getting a bit of resistance. That's right around $317. We did have a decent bounce right from our underside support at 283, 284 on Friday. So seeing that is good, but this still has a lot of proving to do. Right now, it's kind of in a broadening range. I wouldn't quite call it a megaphone yet, although I guess you maybe could make an argument for that, but with higher highs and higher lows. So this is a pattern, at least potentially shaping up, that indicates some level of indecision, but also increasing volatility, as we can see by those higher swings, whereas more often than not, we see compressing ranges as we have, this symmetrical triangle pattern here. So if price moves up or down, more often you see a compressing tightening range, which is just that conversation between buyers and sellers as price action tightens up and then eventually breaks out. Similar scenario with a expanding range, but it's indecision with expanding volatility. So we have to keep our eyes on this one to see how it resolves. If Bitcoin continues to be strong, I don't imagine we would get down here to our trend line for underside support. But if Bitcoin sees more of a pullback, it would not be out of the question for MicroStrategy to get to that $240 level. Okay, looking really quickly at Tesla, and we just printed a mean reversion dot on the 4-hour. We almost reset our 4-hour RSI. We broke the bottom of this range on Friday, but we've had a nice bounce up today, and a little bit of strength is starting to come back in for Tesla. And for near-term projections, because I still have those pesky short expiry calls for 450 expiring on Friday, so maybe I will get out unscathed, but I'm going to go to my favorite 144-minute timeline for Tesla. And I was getting worried on this one on Friday because we broke into the lower band. We normally take a couple swings down in the lower band. We're able to reclaim it today, got a buy signal on the 144-minute time frame, which is what I've been looking for. Optimized trend is about to flip positive, so let's see if this can follow through. And just please, Tesla, get above 350 and save me on those calls. Even if I get out, even I would be happy. I knew it was a risky move. I knew I was, taking a gamble. And as we said in the intro with that Trump meme, no crying in the casino. Anyway, short term, Tesla's looking all right. And if this continues, we should still look at our price extensions of that 500 to 535. And then I imagine we would see a little bit more of a correction and a cool off for Tesla. Okay, looking briefly to RGTI because it has defied expectations yet again and overshot our next price target at $48. We are almost at 58 now. We got to 56 overnight. And our next fib extension, the 1618, is right at about $58. So today, near the end of the day, I got rid of half my spot position because my spot from the $13 purchase was now up over 280%. And this has gone vertical. I know it could run a little bit more on hype, but I don't want to leave profits on the table. I would rather take those chips and rotate them to another play, like some of the miners we discussed this morning, or another couple names that we will get to at the end of the video. And there are actually 3 or 4 other trades I'm looking to take at the middle of this week that I'll report on on Friday. So just looking to reposition those gains. And if this has a pullback, I would get back in. I think the roadmap for some of these is very interesting looking out to 2030, but I think there are going to be a lot of bumps along the road. Not all of them are going to make it. So if you've made good money, there's no harm in locking in profits, and there's always another opportunity in markets. But that brings us to QUBT, which has been the laggard in the space. And this has also broken out of a symmetrical triangle pattern like RGTI did a few weeks or a couple months ago. And I can just, let's go to the daily so we can fully see that symmetrical triangle, massive symmetrical triangle. And we have a cup and handle pattern as well. And it has these upside price targets at $39 to $45. And it is the one in the space that has not moved. It's just consolidated above this breakout. So I would really like to see some follow through and some volume pickup. We had another back test on Friday and a bounce away today. We're just under a little bit of resistance at these previous all-time highs at 2177. We're a little below that right now. So if this can break out and show some good follow through, that would be a great sign. My calls are still doing okay. They're not up massively, but because we got in right at the breakout on those calls, they're not underwater. But this needs to start doing something soon, because if the rest of the quantum computing space pulls back and this hasn't run yet, it would be, I think, challenging for this to make a run on its own without momentum from the rest of the sector. Okay, one I haven't talked about in a while, which is BBAI. And if you guys recall a few weeks ago on this run up, because we had that 8-9 days up consecutively, which often leads to a sharper pullback, which we saw, I sold my spot position in BBAI. This is a riskier one. Their balance sheet admittedly is terrible, but they've gotten great momentum on the backs of more government contracts. They have an order backlog that they can't keep up with. And it had a back test of the breakout from this symmetrical triangle and just shot away today. So now we have to look to overhead price targets for this. And this one could have a bright future if we're just measuring the symmetrical triangle breakout. And in terms of measuring the breakout, we could take the aggressive or the conservative target. Most people say measure from the opening. You could, if you want to be conservative, you could measure just the area from the second touch point here of the symmetrical triangle. But you know what? Let's have fun. Let's go with the aggressive price target, and we'll map that there to the first breakout. Symmetrical triangles are some of the least reliable patterns. They deviate a ton towards the apex of the symmetrical triangle. But if we look to the upside, that is putting us at $16.90, which is right between the 150% and the 1618 fib extension, which makes a lot of sense as a target if this could run. So from current prices at the close today, if we measure up to just the middle of that range, that would be 91% from here. So I'm hoping this one can get some follow through, and we want to see that volume follow through as well, and can play a bit of catch up with the rest of the quantum computing space. Okay, one we have been talking about a bit, but not too often, which is Gemini. And this one, I have IPO shares, and I bought a little bit more, around $23. We have had a little bit of a breakdown on this from the average range, but if we look at these lows, we did potentially just form a double bottom. So I have now, because this one is underperforming and I want to rotate my capital into winning assets, I would rather get out of this if we break below this trend line. So I have my limit order set already, that if we get down to $21 and change, that it'll automatically sell me out of my position. I'm happy to take the little loss on this one and the tax write-off and rotate the capital into another play. But if this is truly a double bottom, then we can measure out where those targets might get us. And if we just map this out right here, that would get us to about $31. We're currently at $23.42, which also makes a lot of sense as a target. We usually don't hit this to the exact dollar and cent. It's just a range, and we would probably overshoot it. But that aligns with the bottom of this consolidation range where we found a lot of support after the IPO before breaking down. So let's see if this can get a recovery on. If it can, I'll stay in it. If not, I'll get out and I'll report on what I'm rotating those proceeds into. Okay, last one for the day, which is MRNA Moderna. And a lot of you might not like this from the 2021 times. It was a wonderful one to trade back then. If we just, let's go to the weekly real quick just for fun, right? Oh my gosh, this one went to the moon and back again. It started at prices we were at now, at around the $20 range, and shot all the way up to almost $500 at the all-time high, and has just come in back to earth massively. And the reason I am looking at it now, and we can honestly just stay on the weekly, is we've formed this strong base since March where we are just not dropping below $23 and change. And we had a little peak in the middle of that. You know what? I am going to go back to the daily. But it seems like we're recovering. If we can get back in the weekly center cloud, that would be a great first sign on the weekly chart. But if you go to the daily and we just look at this right here, we obviously came back down. We couldn't do anything on this move, got a sell signal. And now we're just forming subtle positive structure in terms of we made two lows right here, two even lows, and then higher high, higher low, higher high. Is this going to be our next higher low and continue away from there? So I bought some leaps on this today, and apparently they have some interesting things in the hopper. They're still early days on cancer cures and a few other things they're working on. So this one's really beat up, but it could provide meaningful upside moves. And we have the confluence model bands just squeezing on this. So this for me, it's a small position. Got those leaps out a couple of years, and I will just kind of set this one and forget it. If it comes back down a little bit to the $25 range, actually, let me just set an alert right there. Then I would add some more leaps to my position. But even if we just get to these highs here and we do confirm this as a double bottom and we measure out our price target from that intervening peak to there, and then we project that out off of the intervening peak, that would take us out to $48, which from our current price at the close today is 82% up from here. So even if we just make that move, I would be happy with that. So that is it for the charts. This week, just keep an eye on those recoveries for both equities and crypto. If we get back near all-time highs towards the end of the week, that positive momentum will most likely continue, and it will be a sharper, quicker recovery. However, if we are met by more chop, expect a couple of weeks of consolidation before the next leg higher. And there may be some great deals to be found within that latter scenario. So I hope you all enjoy the week ahead. I will see you on Friday for the weekly wrap-up. Bye for now.